Hello, this video is to see how token or crypto market maker works and what is delta hedge doing as part of the market making. So when we talk about token or crypto issue, one way is to go to decentralized exchange, and short for DEX, DEX. Usually means Uniswap and SushiSwap. There's a lot of DEX there for every chain. So if it is in Uniswap, it follows the Uniswap curve x times y equals to a constant, and you can choose the market making range to avoid larger impermanent loss, but still have impermanent loss usually. Another way is to go to centralized exchange, and the token issuer need to contract a market maker to provide a liquidity service. It usually takes 3 to 6 months. Right now, there are many market makers, for example, GSR, Automated Research, or some exchange itself will provide a liquidity service. And some project team with well-funded, they are hiring a small team of market maker from the other market maker like Tower Research or GSR to make their own team. In this 3 to 6 months market making contract, the project team will give the market maker free token, and the market maker have to return either the number of tokens or the stablecoin equivalent value of tokens. For example, if market maker receive 100 tokens at $1 per token, after the contract ends, the market maker have to return either 100 tokens or $100 USDC or USDT. So it is either or relationship, and this is a call option that market maker is in long position. One important thing to remember here is market maker. This is a free option for market maker, and even project teams sometimes need to pay market maker to provide the liquidity service. So if the market is bullish, the market maker portfolio value increase all the way to the moon. But right now it's a bear market, so the value of option will be down early as it is not Bitcoin or Ether. So in the end, both intrinsic value and the time value of this call option will go to 0. But it is still okay for market maker because it's a free option. So you can do delta hedge. It's really hard to make a loss. It's very easy to make a profit. So for here, because we are doing market making embedded with a free call option, and this call option need to be delta hedge. But here I want to say that not everyone need to delta hedge, because if you are confident, if you have the signal for directional bet and the hit rate is very high, or your winning rate is really high, you don't need to do delta hedge. So if you know the price, where the price action goes, you really do not need to delta hedge. But most of the market makers don't have such a team to directional bet. So let's break down the P&L of an option. One of my previous videos do that, so I will simplify the process here. It's based on the Taylor expansion. The P&L is coming from delta, gamma, theta, rho, and vega things. Here we take it for a simple case and ignore rho and the vega here, but in practice, it's a really important. Don't ignore rho and vega, but here I just want to break down neede into gamma, delta, and the theta part for simplicity. Gamma and the theta can be expressed with each other, and in final we have the P&L breakdown as a relationship as dollar gamma times. So the first part is 1/2 gamma times s squared, and this whole part is called dollar gamma, which is your gamma in dollars, and times the difference between the realized volatility, realized variance, and implied variance. So the term delta S divided by S is the return, and if you think about the cumulative P&L, which gives you the sum of these returns squared, this is actually the variance. And this sum follows a normal distribution based on central limit theory. So here is a reminder for central limit theory, or whatever your previous distribution is, your average and sum will always be normal. So the long position In call option makes money when realized vol is larger than implied vol, which is usually happens in bear market, and lose money. In most of the cases, we just make less profit rather than lose money. So lose money here is not accurate. We just make less profit when realized vol is smaller than implied vol. In more intuitive way, we make more money when market is volatile and make less money. Note here, it's not a loss when market is stable. I did a backtest. It's a very rough backtest. Every backtest has its weakness. Every backtest is wrong, but it gives a big picture of how it looks. So this backtest for the last 6 months, which covers the bear market from November to May to 2022. The first 1 or 2 weeks in December is where I have the drawdown, as the price action does not change too much, but the whole profit and loss looks good. So after this drawdown goes directly up. Finally, if you consider the market impact and the commission fee, usually market makers, especially the large market maker, they don't have the transaction fee as a positive. They have negative transaction fee, which means that each transaction they receive some money. So the final P&L usually around 200% after 6 months, which seems good. And you will see some very high Sharpe ratio here, but I don't really care about a Sharpe ratio, to be honest, as a person. So now let's think about the risk and wrap it up. The delta hedger will experience a drawdown when market is stable. This is true, but in the bearish market, the market is really hard to keep stable. So that's the first risk. I don't really care too much about it. The second one is the gamma, especially the dollar gamma. It's like a leverage and cannot be so large, because if your leverage is so large, your P&L will be very volatile, especially when the market is stable. However, we do not need to care about too much about gamma, because our call option is out of money and will go deeper out of money, because your current price, your underlying price keeps going down. It's not Bitcoin, it's not Ether, it's some altcoins, and some altcoins will never have a large short squeeze. Alright, I think that's all for today's video, and thanks for watching. If you like this video, please give me a like or subscribe my channel, and there will be more quant and crypto related content coming here. Finally, the last thing is that you are market making a free call option, so it's really hard to lose money. You just make less money. Okay, thanks for watching, and see you next.